Hello, my name is Vaaman. My project is portfolio optimization using reinforcement learning with PPO, which is proximal policy optimization. So first I will talk about the motivation for this project, why I decided to choose this project, and why I specifically decided to use RL for portfolio optimization. So first, I would like so my my aspiration is to pursue a career in finance. So that's something I'm really passionate about, and portfolio optimization is something that every trader strives to achieve. And manual methods are quite hard, and uh, an AI method is very important to achieve like good results. So that's why I decided, portfolio optimization. And so why do we use RL and why not use like you have traditional systematic methods? So the issues with traditional portfolio methods are that they are static, they depend on fixed statistical assumptions, and are not able to bend to the rules of the market unless the coder defines it explicitly. They are only look backward, so they optimize based on past risk return estimates and not evolving market dynamics. They're unable to see changing patterns, and they're non-adaptive. They fail to rebalance efficiently when volatility or correlations change. So markets are highly dynamic, highly volatile, highly changing. You cannot have a fixed static method to try to understand how it works. You will need a dynamically changing way of trading, and that is what reinforcement learning does. So it is adaptive and self-learning. The agent learns directly from market feedback. uh, it has autonomous execution. Once trained, runs without manual and can execute trades without human intervention. And it has dynamic decision making. It adjusts allocations each day as conditions change, and it can buy, sell, and do whatever with the cash and the stocks based on whatever it calculates. So then I'll define the problem statement and the objective. So the core problem is to allocate cash optimally among 10 stocks to maximize portfolio returns. So I have chosen 10 stocks. The reasons for why 10 and why those 10 I'll explain later. So traditional methods would assume stationary covariances and fixed risk return trade-offs. So now I'll need a dynamic adaptive agent, such as an RL model, that learns directly from market feedback. So the objective of the project is to build a PPO reinforcement learning agent that will observe recent returns of the 10 stocks which I've defined, which is the state space. Then it will decide the allocation weights and how much cash to allocate to which stock at what time period, which is called the action. And then it will receive profit as reward. So our RL model does work on the reward and penalty principle. So then I will use Nifty 50, which is a standard metric in the Indian market, and then I'll calculate the performance metrics based on that. So, what is reinforcement learning? So, reinforcement learning is an unsupervised learning part of artificial intelligence. So, uh, it's all about learning through interaction and experience and learning from mistakes. So, an agent, it doesn't get a labeled data set like it does in supervised learning and neural networks or traditional neural networks. Instead, it acts in an environment, observes the outcome, and learns from rewards or penalties. So rewards and penalties are basically, it is a function called the reward function, which will determine if the RL model is doing what it should or not. So good outcomes will lead to rewards and bad outcomes will lead to penalties. So the goal obviously of the agent is to maximize the rewards. So it is actually like a human being who is trying to maximize his returns in the world, and he will learn from his mistakes or she'll learn from her mistakes. So the point is to reduce the penalties and increase the rewards. So every RL model has five core components. So one, you have the agent, which is the learner or decision maker. In this case, it's the model which is going to trade. Then you have the environment, which is the world which is providing feedback for it to learn. In this case, it is the Indian stock market. Uh, then you have the state space, which is what the agent observes at time t. It basically looks at the stock price. That's what the state is of each stock. And then you have the action, which is what the agent decides to do. Either you can buy, sell, or hold. And then you have the reward, which is the feedback signal, which is guiding the learning of the model. So then I'll move on to the procedure of how I systematically coded and build this project. So first I have data collection and preparation. So stock data is can be very noisy naturally because there are innumerable factors which come into defining stock price. You have stock traders, you have You have say your sentiment factors, macroeconomic factors, insider trading factors. So choosing which stocks to choose is crucial. So large cap stocks are preferred as they show smoother movements and lower volatility, easier to understand patterns. So stocks, and I will choose from various sectors so that you can negate sector risk or unsystematic risk, and whatever patterns will be diversified as much as possible. So then I've taken data for about 10 years, and the last 500 or one and a half, close to 1.5 years, is chosen for backtesting. And the converted closing prices, I'm converting into daily log returns and not just the raw prices, because logs, when numbers are compounded, the logs can be added, which are much easier for the networks to understand. So the normalized inputs are normalized to keep feature scales consistent. So the stocks I've chosen are all large-scale, well-known stocks. You have Airtel, HDFC Bank, Hindustan Unilever, ICICI Bank, Infosys, ITC, Kotak Bank, L&T, Reliance Industries, and TCS. Companies, large companies from various sectors. So then I built the custom RL environment. So I implemented it as a custom OpenAI gym style environment, which is gym is basically the gymnasium, which is the environment used. So for RL, it defines how the PPO agent interacts with the stimulated market. So the main functions are the reset function, which is basically it calculates, it sets the portfolio value. I have started the portfolio value at 1 lakh. That is the total amount of cash I'm giving it in the beginning. Then the reset, it gives equal cash to all the 10 stocks. So it will divide the portfolio value by 10 and give each, and then it will return this as the initial state vector. So this is, it defines the initial state space. Then you have the step, which takes action, and that function which will apply the agent's action. It will calculate portfolio returns and transaction costs, and then based on that it will update portfolio value and the state. So this it does with the PPO, interaction with the PPO, and it will allocate capital accordingly. Then you have the reward model. So at every time step t, the reward is basically the log of portfolio return minus transaction penalty. So this is basically what the agent is going to receive based on its actions, and this is what the agent will try to maximize. So as you can see, it has two components. One is the log of the returns component, and one you have the transactional cost component. So the log, I take log for the, like I said, I take log returns is because logs can be added when returns are multiplied, and since returns are multiplied in a compounding space, added logs will make it much easier for networks to learn. And in real life trading, all transactions come with a cost, including retail trading apps like Kite from Zerodha. You have a transaction cost, a minimal transaction cost, so it's usually 0.1%. So the goal of the agent is to make profits, but at the same time reduce transactions as much as it can. So it doesn't make unnecessary buy sell moves. So then you have the first term, which will reward growth in total portfolio value, the log term, and then the second term, which will penalize frequent transactions, so that you have a stable growing portfolio and not a rapidly changing spiky one. So then I will talk about the proximal policy optimization, which is the most important component in this uh, agent. So it is called, it's PPO for short. It's a reinforcement learning algorithm which works on policy gradient. So you have an actor-critic pair, which both are neural networks. The actor, it suggests portfolio weights, which is called the policy, and then you have the critic, which will estimate these values, basically the future returns possible, and it will try to optimize it as much as it can, and then provide this feedback back to the actor. So these two complement each other and improve stability by restricting large policy updates. So now, why is PPO suitable for finance? It's because, first of all, it uses in continuous action space. Since the allocated money is in fractions of the total money, so let's say 0.23 of the cash value will go to company A, 0.22 will go to company B, and maybe the remaining will just stay as cash. So since it is fractional weight allocations, PPO is suitable for that. It is sample efficient. It doesn't need that many epochs or that many data points, so it can still learn effectively from limited data and epochs. It has low variance gradients, better convergence on noisy market data. So the first part of the PPO is the actor network, which is the decision maker. The actor network represents the policy function, which is defined as the pi of parameter theta. It's associated with an action AT and a state ST. So it decides what action, which is basically portfolio allocation, to take given the current state, which is basically market conditions, price, movement, returns, etc. So it takes input as a current state vector, market information, and the recent returns, portfolio weights, cash, etc. It will output an action vector, which is basically how much cash should go to what company. So it will implement as a neural network with parameters theta. So, and it will try to optimize accordingly and come up with the most optimal uh, the allocation spread. So it will learn to maximize expected return while staying stable so that the rewards also are maximized. So now talking about the math behind actor is that it is a probability distribution, and that is how you define the pi of theta. But at the same time, you have something called the clipped gradient. So the clip gradient is something that is preventing the agent from making drastic decisions based on one or two drastic days. So let's say if today the market moved very violently, went up or went down 15%, the agent might be tempted to forget past data and go and make a decision purely on the current drastic change. This, so this will lead to spikes and usually uh, basically inaccurate transactions. So the clip, that's what it makes sure that it keeps a cap on the maximum or the most drastic change the parameters or the allocation can take. So here you have RT, which is the probability ratio, which is the ratio of uh, like today's returns divided by yesterday's returns, and A of T is the advantage, how much better an action was than expected, and epsilon is the clipping threshold, which is about zero point 0.1, zero point 0.2. So that is something that I tried various values until I achieved it about 0.15, I believe. So that way you come up with a way so that you have profits, but in a very stable, non-spiky method. Then you have the critic network, which is the second half of the PPO. It's called the value estimator. The critic network estimates the value function V of phi. So it's basically the prediction of how good the current state is by calculating the future possible values, the future possible returns. So it will take the current state as input, and it will give out an estimate, which is the possible future value. So you will train it using simple regression to minimize the difference between the predicted and actual returns. Uh, so that way you achieve so that you're making the critic so that it can critique properly. So that next time once the model is trained, it is able to accurately predict the future possible returns based on the current state. So it doesn't make decisions, it evaluates how good the situation is and relays this feedback to the actor. So as you can see, the actor and critic hence complement each other in a very sophisticated fashion. So then you have the mathematical part for critique. I have the value function approximation, which is the P of phi, which is the expected value of returns given a certain space, state space. Then using simple mean squared error gradient descent, you calculate the loss. And here you make sure that you do not use just the future reward as the face value, but you have to discount it given the fact that 100 rupees, I having 100 rupees right now is more valuable than me having 100 rupees a year later, because 100 rupees I have right now I can convert it to something greater by investing it smartly. So you have to discount to get the discounted current value. So discount factors usually were 0.98, 0.99 per year. That's how you find the present current value. And then you using gradient descent, the critic loss is then minimized, and the critic becomes accurate, able to predict the future possible returns accurately, and it will relay this data to the actor. So I'll just go over the training pipeline. So what I've done so far. So first step is always data collection. I've taken 10 stocks, all large cap, multi sector, to make sure that there is no unsystematic or systematic risk. Then there is data pre-processing. I take the log of returns and not the returns itself, so that when the returns are compounded, the logs can be added, much easier for training. Then you have the RL environment, which has the set and the reset functions. The PPU agent, which contains the actor critic pair. The training model, which so basically the PPU agent is then trained in the RL environment with 8.5 years worth of data, and the remaining 1.5 years of 500 days, close to 500 days, is back tested. So then a variety of metrics and insights are gained, and then the results are documented. So then I'll move on to the evaluation and the results. So to compare the performance between both, you can clearly see that the RL model has significantly outperformed the Nifty 50. So given the fact that all the stocks in the RL, all the 10 stocks are also part of Nifty 50. That is why I also chose, so that because random allocation would lead to a portfolio very similar or almost overlapping with Nifty 50. But because the RL model has successfully managed to map a policy to the market, it is able to figure out how to make uh, superior returns compared to the market. So you can see in a 500-day period, it made more than 32% profits, which is truly remarkable. That beats most of the mutual funds and most of the qualitative traders. It has bet the index fund Nifty 50. That is truly an achievement. So to, it's very important to note that returns are not the only way to measure how good a model is. Especially in finance, you have multiple metrics such as Sharpe, Sortino, max drawdown, CAGR, the volatility annual, the Kalmar ratio, and the hit rate. All these provide crucial insights on how the model is not only able to make profits but is also able to minimize losses and bad decisions. So here on the columns, on the rows, you can see there are weak, good, excellent, exceptional. So these are ranges and metrics that are internationally accepted. Some of these are contributed by CFA, and so these show on what a metric should be so that it can be considered good or excellent. So as you can see, most of the metrics either fall under good and excellent, with I think one or two even falling in exceptional, but not a single one is weak. It shows that the model is truly superior to uh, the non-RL counterparts, and it is able to accurately uh, map market patterns and is able to use that to its own advantage and make incredible profits and incredible results as seen here. So I will talk about each of these metrics in depth so that you can understand how important each of this is in trying to, because all these must be optimized before you can tell that model is market ready. So first you have the Sharpe ratio. So here you're measuring the risk adjusted performance. So it is measuring how much excess return an investment generates for each unit of total risk taken. So this might seem a bit complex, but it is really that is the returns worth the risk? Because that is something we have made in non-trading situations, that you know how risky should something be that you're unwilling to take even though the returns are very high. So that is what the Sharp does. It You find the expected returns, and then you divide it by the portfolio volatility, which is a standard deviation. Usually it is taken for 252 working days, because that's how many working days you have in a year. 252 over 365. So using that, the Sharp is calculated. The PPO has achieved sharp of a 1.31, which is well above the 1, which is a standard baseline. Below 1, it's considered poor. So that shows that the risk associated with the model is more than compensated by the returns generated. It is producing 1.31 units of return for every 1 unit of risk. That shows it is much better than a random model and that the risk is worth it. So then I will talk about the Sortino ratio. So this measures downside risk performance. So it refines the Sharpe ratio by focusing only on downside volatility, which are returns that fall below a minimum acceptable threshold. So in this case, it is like Sharpe. The formula is very similar, but I am not calculating the volatility when the model has performed well, because it doesn't matter what the deviation was as long as you did make money. But yes, when you lose money, you got to know if it's stable or it is spiky, so that you know that what the deviation is. So here you will use a downside deviation, and the phenomenal thing is the model, though it was not amazing at creating a great Sharpe of 1.3, that means it is sometimes missing out on certain profits. The Sortino of 2.11 indicates that it has managed to negate any possible loss making opportunities. That shows 2.11 falls in the exceptional category, means that uh, the model is not taking any or very few loss making trades. So it is able to minimize losses while maintaining healthy upside volatility. So it shows that the strategy is protecting its capital during drawdowns, and even when the market loses money, uh, what the PPO is doing is it is not allocating any cash so that the cash stays safe, and when the market rebounds, then it starts allocating again. So this in fact shows that how resistant it is to the market tanks. So next I will talk about maximum drawdown, which is basically measuring the capital risk exposure. So this it basically measures the maximum loss you can make. So if you make the worst trade possible in the model, which is buying it at the highest point and selling it at the lowest point, what is the um, like before a new high is reached, what is the worst loss you can make? So usually it is this number can go anywhere from 10% to 30, sometimes even more, because there might be cases where on a day or two where the model performed very badly and there was massive drops. But here you can see that it's only 10.73%. That the worst possible trade you can make will only fetch you a loss of just 10.73%, which again falls under the excellent category. So this shows that the RL agent that it's able to control downside losses effectively. So it is able to again protect its capital properly for an actively managed portfolio. That yes, it is making profits and making sure that there are no losses. Equally important. So now I'll talk about CAGR. So this is the most commonly used metric when talking about uh, trading, because people they usually do not talk that my sharp was this, my sortino was this, but they will tell yes, my CAGR was this, because this is what is the closest thing to returns. It is compounded annual growth rate, which will so because the model produces uneven returns. It will produce like maybe 3% for the first year, then 25% for the next year, and it will be very spiky with high volatility. So this is assuming that with minimal volatility and with a smooth increase, what is the calculated annual growth rate? So as you can see, the formula, it is just the ratio, the final and initial portfolio value, and then you do 1 by t minus 1. So this PPO has achieved a CAGR of 16.76%, which is considered excellent. That shows that it is able to, given that the volatility was also low, it is able to produce profits of 16.76% year on year on year. Truly phenomenal. That shows it's able to double its cash in only about 4.5 years. So you compound that of over decades, in 40-45 years you have a portfolio 1,000 times the initial started. So in the end, CAGR is the most visible thing that is seen to investors as how much profits am I making year on year. So this will indicate the profitability and stability over time. Then I'll have you have the volatility, which you're measuring as a return variability. So it is simply the variance of the annual returns. Oh, sorry, variance of the daily returns annually. So and then you square root that to get the standard deviation, which is the volatility. The model got a volatility of 12.65%, which is again excellent. So it means that the model has achieved its returns with more stability and less risk. It's a desirable characteristic. So it shows that the achieved volatility, it highlights the agent's effectiveness in maintaining balance between risk and return. Then you have the gamma ratio. So this is one of the lesser known ratios, but equally important. So it takes two very opposite metrics. You have the CAGR, which calculates annual returns. Then you have the math drawdowns, which contains maximum losses. So now you're trying to see that for given the maximum losses, am I able to compensate it with a good healthy CAGR? So in this case, I would definitely want to make sure that my CAGR is more than my max drawdown, so that even if I make a certain amount of loss, I'm able by the end of the year able to throw it away thanks to the CAGR going up more than the max drawdown. So my PPO has achieved a or gamma ratio of 1.56, which means that the CAGR is going up 1.56 more than the drawdown. So therefore, even if the drawdown shows in a given year, on average, by the end of the year, I'll still be making a profit. So that means there's a trade-off between the reward and the capital which is protected. So it suggests that the RL model, it maintains healthy returns with disciplined risk management. Again, very, very crucial when I'm building a portfolio. Then you have the hit rate, which measures the consistency of profitable decisions. This is very simple, really. It is quite a rudimentary tool and not very important. It is quite overlooked because you have portfolios which perform less than ideal hit rate but still achieve phenomenally. So it is simply the ratio, the number of days or the number of times the model gave profits divided by the total number of times. So ideally, you would want it to be over 50% because then at least you're making profits on more than half the times. This model just manages that with 52.3%. It is considered good. This is not phenomenal, but keep in mind that the 52.3% times it made profits, it would have made high profits, while the times it made losses, it would have made small losses. So then the overall net returns will be very high. So even though that this is something, it's like a safety spot where you would want to keep the hit rate over 50%. It is not very important, but still you can show to show that I'm having a consistent and stable performance over years. So because obviously the profits on the winning trades alone matter more than the number of profit trades. So that comes with the end of the metrics. So as you can see that uh, all the metrics performed phenomenally. All of them showed that the model is robust, ideal for trading already. So that really shows the power of PPO, because uh, it is something that standard non-RL models have failed to achieve over decades, and the PPO has just done instantly. So the limitations and challenges for this will include some of them which I feel uh, that can be achieved with better computing and better infra. But at the moment, these are some things that kind of bog down my progress. So one is the data constraints. We have the limited historical price data of only 10 stocks, because if I use more stocks, that puts a huge toll on computing and efficiency power, and that would have taken way more time and could have created hallucinating results. So therefore, 10 stocks only were taken. It involved high computational load, because RL, because it is trying different things, I needed to run it for about 100,000 time steps before it was able to converge to a minimal loss. So that is one issue, high computational load. Then you have the transaction cost and slippage. So in real life, this is not what happens. The model predicts that the transactional costs are going to be constant, but in real life, it keeps changing. You have a lot of factors, you have vendor factors. So that is something that can become crucial in real life when it trades in real life. Then you have the market non-stationarity. So a model that is trained on past data might underperform under new market regimes unless retrained periodically. So yes, for example, in different markets in different countries with different configurations, there might be slight changes on how the model is configured, which might starkly reduce its performance and efficiency. So the possible improvements that could have been done, but due to constraints was unable to, is I can implement a multi-agent or hierarchical RL. So extend the PPO into a multi-agent setup. So now instead of one RL model for all the companies, you can break it sector-wise, you can break it cap-wise, you can break it investor risk appetite-wise. I can have one RL model for investors with low appetite risk, one RL model for investors with high appetite risk. So that way, each sector, each bracket can get full focus with a single RL model, which will definitely increase uh, the performance, but will also increase computational power. Also, I could have incorporated alternative data sources such as news articles or or qualitative fundamental data, sentiment analysis, volatility indices, but that again would have taken a toll on data storing and computation. Live trading simulation is something that I also strive to do with this model, trying to connect this to the server so that this can actually trade with paper money and then move on to actual cash trading, because it has proven to be a fail-safe ironclad model. So it should definitely work in real markets. And I would want to incorporate transaction frictions, because I've assumed that if it wants to buy, it can buy. If it wants to sell, it can sell. But in real life, that may necessarily not happen. There might be situations where the transaction does not go through, or there might be issues with the platform, and then the model is ill-equipped to deal with those kind of issues. So in conclusion, I would like to say that the proximal policy optimization was a success, that it was able to accurately allocate cash across 10 Indian equities, and using a reward and trading logic feedback, it outperformed Nifty 50 and performed well across all metrics. So the insights I can draw from this would be that the AI-driven portfolio optimization is the future in finance. can definitely outperform static models by learning risk reward trade offs directly from experience. Because I, from a home computer with limited resources, have managed to build a very well working model. Who knows what we can do with really strong computational and algorithmic practices? So, and reinforcement learning is spearheading that revolution, which is able to dynamically adapt to changing market conditions without explicit supervision. So, thank you. That's all there is from me. And thank you, sir, for this opportunity. I really enjoyed doing this project. So, thank you for including part of the curriculum.